Welcome to London. I've just recorded an interview with Ian Wood, Chief Investment Officer at Titan Private Wealth. We talk about Ian's approach to investing, the stocks he likes, and how he constructs portfolios. So we're going to talk a little bit about your investment process, how you manage money for clients. But before we get into that, it'd be great to hear a little bit about your background and also the history of Titan Private Wealth.
So I'm 49 years old. I've worked at Titan Private Wealth, which previously Cardale, for 17 years. I have a very big quant background, so I studied physics at Durham University, moved into the investment management industry straight after university. I'm married with 3 kids. I play cricket. I'm still playing cricket, quite poorly these days. My younger and older son are both heavily involved with Yorkshire County Cricket Club, and we're enjoying playing cricket together. So that's
Fantastic. And your investment approach is quite unique. Perhaps you could tell us a little bit more about how you go deciding which stocks make your portfolio.
We're very, very simple. We don't try to overcomplicate things. So like everybody else, we're trying to buy the best quality businesses that we can find. But the important thing is that we don't want to overpay for those businesses. And that's absolutely crucial, because the best business in the world might not be the best investment if you pay the wrong price. So a prime example of that would be something like Cisco Systems. Incredibly successful business over the last 24 years. But if you bought it in 2000, you've still not got your money back because you paid the wrong price in the first instance. And that's what we're desperately trying to avoid.
Fantastic. And what's your favourite stock of the moment? What are the names that sort of jump to mind?
So favourite stock, probably the best business in the world is probably Hermes, luxury goods business. Metronomically grown its revenues and free cash flows at 10 to 15% a year over the last 20 years. Remarkable pricing power, obviously driven by brand strength. Very difficult to understand how anybody can compete with that type of brand that's been built up over that length of time. And because of the return on capital that it generates and reinvests its free cash flow into those returns, you get that compounding effect of free cash flow growth. And we think that free cash flow drives share price performance over the long term.
And the luxury segment has been resilient, hasn't it? Even in times of economic difficulty. And Hermes is a great example of that, isn't it?
Yeah, I think if you're willing to spend £10,000 or £15,000 on a handbag, you're probably willing to pay £15,000 to £20,000. So that pricing power enables them to increase prices, and they increase profits through increasing price and volume year on year. And it becomes a remarkably stable business. And it's the longevity of growth that we're interested in. And what you want from an equity is a business that's going to be around for a long time and grow. As the free cash flow grows, the share price appreciates.
And what about the ones that got away, the stocks that you missed? Have you passed up the Beatles, as it were, in your investing journey?
There's been plenty of those. So the obvious one's quite topical now, which is Nvidia. We own Nvidia now. We bought it too late. We've done very, very well for clients on it, but we missed the first 200%. I kick myself on this one, because Nvidia, we had an opportunity to buy Nvidia early last year before the AI story sort of really came to the fore. But even because of the way that we look at stocks, even though the share price had gone up a lot, it still looked very, very attractively valued to us. Massive competitive advantage in AI processing. And as a result of that, we were happy to continue to buy the stock, even though the share price had gone up, twofold, threefold. So yes, it's one of the best and one of the worst at the same time. We missed it definitely, but we got in eventually. So.
And mistakes are inevitable. Mistakes, or when you're trying to look at timing and entering different stocks, is a complex decision process. But what would you say? Is there any mistakes there that are in the background that you learn from? I suppose you build into your.
I think mistakes are inevitable, and if you've not got broad shoulders, it's a very difficult job, because the best in the world are going to get things wrong. There's no magic formula that tells you exactly what you need to do. So the ones that stick to mind for me are things like Micron. We bought a position in Micron going back quite a few years. We misunderstood the cyclicality in the semiconductor memory cycle. We bought it badly, we sold it badly. But my view is, if you learn from the mistakes and you improve your process each time, then you win, and the process becomes more robust over time.
And how diversified is a typical portfolio if you have stocks that don't quite perform? I mean, what's the diversification like?
Yeah, so we're obviously diversified by sector. The portfolio is 40 to 50 names. We tend to go back towards the core holdings within the portfolio in times of stress or in times of uncertainty. So we go back to those real strong core businesses. We have 3 different types of stocks in the portfolio. So superior businesses, which are those national champions, great longevity of growth, very high return on capital businesses, and we want to own those forever. The next bucket down are the core positions, which are very good quality businesses, but have got some cyclicality in them. So they're not immune to economic conditions. And then the third bucket are the special situations, which tend to be valuation opportunities, lower quality businesses that are trading on a valuation that materially undervalues the business.
And how is what you do at Titan Private Wealth different to your competitors? There's many ways to manage money, many people out there doing it. How do you put yourself?
Yeah, I mean, there are obvious similarities, and a lot of the names in the portfolio are household names. Lots of people own them, and I think from a quality perspective, the way that we look at quality is the longevity of return on capital. That's very, very easy to screen for. Anybody with a Bloomberg terminal can do 1,500 stocks in 5 minutes. I don't think we add anything there. Everybody knows what the best quality companies are. I think where we are slightly different is we value stocks in a different way to most. So we don't look at near year earnings multiples, simply because we don't think it tells you anything about a stock and it's subjective. So you might say to me that Novo Nordisk's expensive on 25 times, and I might say, well, I think it's expensive on 30 times. And there's no formula out there. I've looked for 30 years, there's no formula out there that tells you what EV/EBIT multiple or P ratio a stock should trade on for its growth and quality. So the way we do it is we look at the implied growth rates. So we use a discounted cash flow, but rather than using it to generate a price target, we reverse engineer the discounted cash flow in order to derive a terminal free cash flow growth rate that's required to justify the current share price. So for example, in Nvidia right now, we think the terminal growth rate is around 4 to 5%. And then we look back as far as we can and say, what's it grown at in the past? And what is it expected to grow at in the next 5 years? Nobody knows what it grows at for 25 years. But if we get that margin of safety, so if Nvidia needs to grow at 4 or 5, and it's historically grown at 10 and is expected to grow at 10, 15, then we've got a margin of safety. And Hermes would be a prime example of this. So Hermes is not a cheap stock. It's a very good quality stock. The implied free cash flow growth rate, according to our model, is 6%, but it's always grown at 12. So we have so its growth rate needs to halve to justify the current share price. And I think that lets us run our winners for longer. So if we'd bought a Novo Nordisk on 18 times earnings, which we did 3 or 4 years ago, it's now on 28, 29 times. You're almost inclined to sell that stock because it's a lot more expensive on a near year earnings multiple. But what difference does it make what a stock trades on full year 25? We're really interested in that longevity of free cash flow growth. So what it's going to make over the next 20, 25 years. And so if we've got that margin of safety, we're comfortable buying these things.
And these models can be used to analyse companies here in the UK, but also overseas. I mean, I know that you're not UK focused, as it were. I mean, perhaps tell us a little bit about the geographic split in the portfolio.
We were very UK focused, probably going back 10 years. We were like most of the DFMs, we had a home market bias. But because we're very quant based, we have a screen that screens developed market equities. And the conversation was around, we were looking to add some oil exposure into the portfolio, and we'd look at BP and Shell. And I said, why don't we look at Exxon and Total? We can look at these things. We have a model, we have an equity valuation sheet that values any company anywhere in the world just by typing the ticker symbol in. And the only thing that it introduces is a little bit of FX risk. We don't care where it's listed, but predominantly we're going to invest in strong currencies. So in times of market stress, the FX it dampens down our volatility because the US dollar tends to perform well as a risk-off currency. So we quite like the FX risk that's in the portfolio, so we don't hedge that. So as a result, whether we like it or not as Englishmen, most of the best companies in the world are American. Lots of good businesses in Europe and lots of good businesses in Japan. And we get exposure to emerging market growth and Asian growth through developed market equities. And we do that because there's a governance issue in emerging markets, and because we're quant-based, we need international reporting standards. So we don't invest directly in emerging market and Asian stocks, and we're more comfortable. So 25% of the revenue of the portfolio comes from Asia and emerging markets. So it's not, we are exposed, we'd just rather do it through developed markets because we're very conservative.
Okay, and in terms of equity versus fixed income, I mean, what are you doing in the fixed income space? There's a lot of change with rate moves.
Yeah, well, for the first time in a long time, we've had the ability to invest in sovereign debt. For a long time we've been zero weighted, and you have to go down the credit rating scale in order to generate a real return for clients. But nowadays with the front end of the curve, 4 or 5%, that becomes a diversifier and a profit center for portfolios. We are very plain vanilla in fixed income, so we are sovereign and investment grade credit, high-end investment grade credit, simply because we have enough risk in the equity portfolio. We we would like the fixed income bucket to protect the downside. We don't see it as a source of massive alpha generation.
So for more conservative investors, I mean, how do you set up sort of the balance between fixed income and more the equity style that you're known for?
Yeah, so I mean, we have 5 different risk profiles, from very high risk to very low risk. The very high risk portfolio is 100% equity, and basically it ratchets down, so in 20% increments. The asset allocation is not fixed. We do move these things around. We are active managers, so if we can see more opportunity in fixed income, we will up the fixed income exposure. And if we can find more value in equities, we'll up the equity exposure. But we have to be mindful of clients' risks, so we do have bandings. We can't go outside.
And obviously, yeah, you are active managers. I mean, the debate around passive and active still rages on to some extent, but I think that the era now suggests that there's a great opportunity for active managers, isn't there? I mean, I imagine you concur with that.
Yeah, well, exactly. I mean, you need to look at the certain stocks that are driving markets, the Magnificent Seven. You know, if you've not been in the Magnificent Seven for the last year or so, you've underperformed. Now, clearly, you can get exposure to that through a passive fund, but we like the ability to, if we really have conviction on a stock, to go overweight and have a bigger exposure to that position. And also, if we don't like one of the very large stocks, you know, we have a position in Apple right now, but we are underweight Apple. It's our biggest underweight position. We own the stock, but we're 2.5% underweight the index because we don't have conviction that that's a great idea. At some point in time, Apple will move out of the portfolio on a competing capital basis. As we find better ideas, we will move that on because we think that it's going through a period of slower growth, and the implied free cash flow growth rate is not as low as we would like it to be for it to be a value proposition.
And what's your attitude to companies and leverage, the amount of debt they're carrying on the balance sheet?
Yeah, we don't invest in highly leveraged companies. Like I said before, you know, equities are a risky asset class. We don't need to multiply that risk by taking on financial leverage. Plus as well, it gives optionality in terms of market stress. So businesses with strong balance sheets might be able to pick up attractive assets at very attractive prices if a company is very highly leveraged. Some great assets out there in highly leveraged businesses. So we like strong balance sheets. We're just very conservative.
How did you devise your approach to investing? I mean, are there books, there sources of there people that you watch that give you inspiration as to how you see markets?
Yeah, I mean, I've been very lucky over the years because we used to do fund selection as well before we moved purely down the direct equity route. So for 10 years, we met probably 5 fund managers a week, some very, very bright guys, talked to us about the process. You take bits on board, you try and work that into your own process. And then I've read, really boringly, a lot of investment books on holiday. I do audio books these days, but yeah, you know, every time I read The Intelligent Investor, you pick up something new that you'd not found before. And I think if anybody's ever going to read a little book that beats the market, Joel Greenblatt's book's a fantastic book, and it takes about 2 hours. And I'm a slow reader. Yeah.
And are there cases where you go through funds? I mean, obviously you've got the preference to own stocks direct.
Yeah.
Where is it that you see funds fitting in?
Yeah, so if we don't have the expertise to invest in a certain area of the market, we find financials very, very difficult. The balance sheets are very difficult to understand. It's a commoditized business in some ways, quite a low quality industry. But at certain points in the cycle, you do want to own banks. We don't have the ability to analyse those balance sheets and have comfort and conviction. So probably the only stock we would own is JP Morgan. But if we wanted a broad basket, we would go and buy a global financials ETF, which gives us our banking exposure.
And your performance numbers have been strong, and that's what attracted Titan to come and buy Cardale. I mean, perhaps what are some of the highlights from the performance numbers over recent years?
I think that the overall highlight has been that we've managed to outperform our peers significantly, and we've been much lower volatility as well. So because we don't have that home market bias, the S&P is a much more stable index, much more diversified, much more liquid. And a result of that, to generate returns above with lower volatility is something that we are quite satisfied about. There's been bad years, unfortunately. The part of the job, and the reason for all the grey hair is that when things go bad, it's very, very unpleasant. But if you believe in your process, you can stick to that process. And we do genuinely believe that buying good quality businesses over the long run will generate attractive returns for clients.
And what's the outlook for 2024 and beyond?
No idea. We don't really do the macro stuff. So at the beginning of 2022, the Fed dot plot suggested two 25 basis point rate hikes, and then clearly rates went to 5.5%. And they've got more information than us. They're brighter than us, and they set the rates. So if they can't get it right, what chance have I got wasting my time trying to understand these things? And at the beginning of 2023, for the first time in 2 decades, the market as a whole thought the S&P would finish the year lower than it started, and it went up 20-odd%. So to me, I feel like I'm wasting my time thinking about these things. I don't think it's something that I can forecast. And I think in some ways, the day that I decided that I can't control this stuff made me better actually picking stocks, because we can actually control the stocks in the portfolio. We can't control the macro. And it's so complex. There's lots of bright people out there telling me different things, so who do you believe? So we don't waste time thinking about it.
Well, Ian, thank you for talking to me today, and I look forward to sharing this interview.
Thanks, David.